All right, so in this video, I'm gonna break down the 3 different types of life insurance policies that you can have, and there's multiple different types of life insurance policies, but I'm gonna keep it simple to 3. And each of these policies serve different purposes, so I'm gonna break it down in this video. And if you guys have questions or comments, feel free to comment in the comment section, and I'll create more response videos to that. So the first type of policy that's out there is a term life insurance policy. I want you to think of this as temporary or terminate. So the beautiful part is that it's affordable. The downside is that it expires. I tell all my clients, if you're gonna get a term policy, you wanna make sure it has 2 things. Number 1, you want to make sure that you have living benefits. This covers you, God forbid you were to get sick, like a heart attack, stroke, cancer, bad accident. Assuming that you qualify for it, you could potentially access a portion of your life insurance policy while you're alive, and you don't have to pay that money back. One of our own agents had a massive stroke at 38 years young. The company direct deposited to his bank account when he had that stroke over $220,000. So you definitely want to make sure your term policy has this. Number 2, you want to make sure it's convertible. What do I mean by that? That policy that you got it through, they also sell permanent life insurance policies, because you got a term policy, you know it's going to expire. You can get a lot of life insurance, pennies on the dollar. However, at some point in time, you may want to upgrade a portion of that policy to a permanent life insurance policy so you can lock in the cost of life insurance. The second type of policy that's out there is ROP, which stands for return of premium. So just like a term policy, it expires. However, this type of policy typically costs 2 to 3 times more than term. Most people that get this, or some companies that market it, will say, hey, you need to get insurance on your home. God forbid something happens to you, your house can be paid off. That's return of premium. So when your policy expires, you get all the money you put inside of your policy back. Most people, again, who get it typically have a mortgage on their home. They want to make sure they have enough life insurance. God forbid something happens. But if nothing happens, they pay off their home, they want to get all their money back, they absolutely can. Last but not least is the third type of policies, which are permanent life insurance policies. These can be whole life policies, these can be universal life policies, it could be index universal life policies, this could be guaranteed universal life policies. There's multiple different types of permanent life insurance policies. The entire gist of it is that it's lifetime coverage. And before people get to arguing permanent life insurance policies is scam, blasey, you guys, we all took the same test, and it's an option for a reason. I wouldn't hope that you would sell a 75-year-old man a term policy. I've seen some people say that they would put them in a high yield savings account. They would put their money in the market. They're literally 75 years old, and God forbid something happens to them. Life insurance is the only asset that will blossom overnight upon them passing away. Anyways, so the whole gist of a permanent life insurance policy is that it offers you lifetime coverage. It does cost more than a term life insurance policy, but the biggest benefit is that you get to lock in the cost of life insurance at whatever age that you lock it in at. There's also some permanent policies out here that can build something that we call cash value that you can leverage and borrow from in the future. Maybe use it to supplement retirement, help send a kid off to college, or maybe you just want your money growing and compounding more than what it's doing in the bank. Well, I was told the permanent policies, they cost more over time, and you got to pay more, and these policies will implode if you're not funding it. Quick educational piece here, okay? When you have a policy that builds cash value up and it's structured the right way, and the death benefit is also structured the right way, there's something called self-insure. And what that means is that actually the cost of life insurance over time gets cheaper because your cash and your policy is growing, which means that the life insurance company is not responsible for as much death benefit because you self-insured yourself through your cash value accumulation. But you only get the death benefit. You don't also get the cash value. It depends on how your policy is structured. There's instances where you don't, and there's instances where you can. Hope you saw the video valuable. Anyways, comment your thoughts in the comment section below. Any questions that you guys have, hit the follow as always, and let's get it. Cheers.